we are going to talk about 4 different topics in this chapter. First, similarly to the capital structure, we are going to learn that the dividend policy can be irrelevant to the value of the company. And then we are going to discuss several factors that might affect the dividend policy in real-world companies. And the third topic will be about the stock repurchases, and we are going to discuss it on this Thursday. And this is a substitute of the cash dividend. And later we are going to talk about the stock dividends, which are similar to the cash dividend that we are going to discuss, but actually it is totally different, so we are going to learn about it. So today we are going to talk about the irrelevance dividend policy and the real-world factors that might affect a company's dividend policy. First, let me start with the dividend policy in general. So what are dividends? A dividend refers to a cash payment, and this cash payment is made out of a firm, especially when the firm has earned something. So this is coming from the firm's earnings, and this cash payment is for the shareholders, the owner of the company. Otherwise, you cannot call it as a dividend. And commonly, in reality, public companies, the companies that are listed in the stock market, they pay dividends 4 times per year. So each quarter, they are going to pay their dividends to their shareholders. And suppose you are a shareholder of a publicly traded company, and you are expecting a dividend from the company. And then the company will decide how much should they give to their shareholders, and then this is the common procedure or the process for the dividend payment. First, the board of the director will declare a dividend, the amount, the date, and these will be decided by the board of directors, and then they will publicly announce it through all different kinds of the mass media. And then we have ex-dividend date, and the definition of this ex-dividend date is just 1 day before the date of record. I'm going to revisit this ex-dividend date soon. And we have date of record, and this is the day that the company prepares a list of shareholders. So this is the day that the company decides who should get the dividends from the company. And lastly, we have a date of payment, which is the actual date where the company pays the dividend that has been decided before. So this is the graph showing. This is a figure showing the procedure in the dividend payment. So suppose there is a company, and this company wants to pay a certain dividend to their shareholders. And first, there is a declaration date, for example, Thursday, January 15. And this is usually at least 2 weeks ago before the record date. And we have a record date on the third point. We have a January 30 as the record date, and this is the date on which the declared dividends will be given to the people who are shareholders at the time. So if you are a shareholder, so if you are holding a share of the company, then you will be on the list, and then later you will get the dividends. On the other hand, if you are not the shareholder at the time, then you will not participate in this dividend payout policy. So this is very important, because if you do not purchase your shares before this record date, then actually you cannot receive the dividends. And therefore, it also emphasize the ex-dividend date, which is January 29. In our example, just one day before this record date. And depending on your stock trade on this day, whether or not you get the dividend will be determined. So because we assume that you should be the shareholder on January 30, that means you have to buy a certain share of the company just at least one day before it. So this is why this is called as an ex-dividend date. So if you are a shareholder at this time, then you are actually purchasing not only the share itself, but also the dividend right at the same time. On the other hand, just after this day, the right to receive the dividend from the company is detached from your share, and it will be gone to other people. So the dividend will be the right of the dividend will be on your share on this day, and this is the last day that you are getting a chance to get the dividend. And finally, you have a payment day, which is another 2 weeks later in reality usually. And so on February 16, you will get the actual payment from the company. So the ex-dividend date is very important. So let me see what happens here. So as I said, let's say the ex-dividend is D0 here, the day 0. And if you are the shareholder at this time, then you are having the right to receive the dividends. So the value of the share, the value of the stock, also includes the value about your dividend. So let's just say the stock price let's just say the stock price is $22 per share, and if the company is planning to give you a $2 dividends, then the stock price will be $22 before the ex-dividend date. However, just after the ex-dividend date, so starting from the record date, the stock price will be reduced as much as the dividend. Because from now on, even though despite the fact that you purchased exactly the same dividend, exactly the same share for a company, your share does not hold the right to receive the dividend anymore. So that's why the stock price will be reduced by the amount of the dividend that the company is planning to pay. So here, this graph, this figure shows that your price before the ex-dividend date and the after ex-dividend date will be different, and the difference between these two prices is actually the same as the dividend. Okay, and now we are coming back to our main question, which is about the dividend policy or the payout policy in general. So the dividend policy is a financial decision of a company, and in this decision making process, what the company wants to decide is to whether or not to pay the dividends more or not. So they are thinking about two different choices. First, they can decide to pay more dividends right now, and it means their retained earnings are going to be reduced, so they cannot invest further. So later, in the future they cannot give you dividends more. On the other hand, if they cut their dividends right now, so the shareholders at this moment can be somewhat disappointed. However, there will be more retained earnings, and using that money, the company can invest in valuable project and they can earn more, and later in the future they can pay more dividends to the shareholders. So this is about the timing of the distribution, whether they want to emphasize the right now, the future, the today, or the future, tomorrow or the next year or 3 years later. And according to a theory, dividend policy is irrelevant under particular circumstances, such as ignoring taxes and assuming that the interest rates are known, and everything under every assumptions, the dividend policy is irrelevant. So actually it does not affect the value of the company, and one of the reasons is because actually investors can create their own homemade dividend policy, and these arguments are very similar to what we learned in the previous chapter when we discussed about the capital structure decision. So let me briefly describe how this kind of irrelevance can be applied through an example of a company, a Wharton Corporation. And for the simplicity, let me assume that Wharton Corporation is not using that. So this company is 100% equity financed. And there are 1,000 shares outstanding. So the number of shares is 1,000. And for the matter of simplicity, I'm just going to assume that this company will continue to operate for the next 2 years, and then later it will be gone. So it will be liquidated. And for each of the years, so we have 2 years, so first year and the second year, and for both of the years, the company will generate a cash flow of 10,000. And the cost of capital, the required rate of return from the point of view of an investor, is 10%. Case 1. The company can choose to have a 100% dividend payout ratio. So the dividend payout ratio is dividend total divided by net income. So this one determines among the net income the company that earned this year, how much should the company distribute to their shareholder. And assuming that the 100% dividend payout ratio means the company will give all the money that they earned this year to their shareholders. And then, because the company earns $10,000 this year, and because they are going to distribute all of them to their shareholders, and because the number of shares are 1,000 for this company, the dividend per share is $10. And this will be the same for 2 years. So in the first year, a shareholder will get $10, and in the next year, in the second year, the same shareholder will get the same amount of dividend to $10 again. So if you interpret the stock as the security to get the dividend, and then the stock price will be determined as the net present value of the future dividends. So and also furthermore, this company will operate only for 2 years, and it will not do so any longer. So the stock price will be purely determined by the dividends in the first year and the dividend in the second year. So the dividend in both of the year are the same as $10, and the required rate of return for an investor is 10%. So by discounting this 10 with respect to 1 plus 0.1 and 10 over 1 plus 0.1 to the power of 2, you can calculate the expected stock price. And the expected stock price today is $17.36. So here what I'm doing is that if you purchase a share today, then I expect to get $10 next year, and 2 years later I'm going to get another $10 from the company. So the value should be the same as $17.36. If it is not, then I have no reason to get the share of the company. And because each of the share is worth $17, and because the number of shares is 1,000, the value of the firm, and because there is no debt, the value of the firm or the value of the equity will be the same as 1,000 times 17.36, which is 17,360. So if suppose that in the second case, suppose that the company changes its dividend payout policy to 50%. It means the half of the net income will be distributed to the shareholders as the dividend. And the dividend per share in the first year is because the net income, the cash flow was $10,000, and the company decides to have 50% of the money given to the shareholders. So therefore 10,000 times 50% is the dividends in total. And because the number of shares is 1,000, each share will get you $5. And the rest of the money, the another 50% of the cash flow will be retained. In other words, it will be added to the retained earnings, and this will be used for the company. And we assume that the company will earn exactly the same rate of return as the investor, and then they will generate 10% return. So therefore, in the second year, the company can have a higher return. Originally, the company is expected to have $10,000 from its operation. However, because it retained $5,000 additionally, and it will also give them another return, so their total cash flow in the second year, in other words, their net income will be increased to $15,500. And therefore, in the second year, the dividend will be also increased. Here, in the second year, there is no reason to retain, because the company will be liquidated whatever happens, so they have to give all the money to their shareholders. Therefore, the dividend per share is the total cash flow divided by the number of shares, and this is $15.50 per share. So therefore, in this second case, the shareholder will receive $5 in the first year and $15 in the second year. So the stock price will be calculated again, and based on the discounted cash flow valuation, the stock price will be 5 divided by 1 plus 0.1 because this is on the first year, and 15.5 divided by 1 plus 0.1 squared because this is on the second year. And actually the calculation will give you $17.36, and it is frankly exactly the same as the previous calculation in case 1. And therefore the value of the company is also the same. The value of the company will be 1,000 times the $17 per share, so it will be $17,360. So these results are exactly the same as the result from the first case. So actually there is no difference whether the company chooses 100% dividend payout ratio or 50% dividend paid out ratio. And in the third case, we go further. So we are going to say that the company wants to have 110% dividend payout ratio for their first year. And then it means they are actually giving more than what they have. So the dividend per share in the first year will be 10,000, which is the cash flow on the first year, times 1.1 because we are having 100% and 10% as the dividend payout ratio, and the number of shares is also the same as 1,000. So the dividend per share will be $11 per share. And this means because the company only has $10,000, but the company needs to pay $11,000 to their shareholders, it means the company needs to have additional $1,000, and the only way is to raise it from the outside investors. And outside investors will invest in this company expecting that the company will give them 10% rate of return. Therefore, they have to give a portion of the money in the second year to the outside investors as a reward for their investment in the first year. So originally the company will have $10,000 in the second year. However, some of them should be given to the outside investors, which is 1,000 times 1.1 plus 0.1. So they have to give $1,100 to the outside investors. Therefore, the company only has $8,900 in total in the second year, and the company will give them to their existing shareholders. So the dividend per share is 8,900 divided by 1,000, and the dividend in the second year will be reduced to $8.90. So in the third case, we have $11 in the first year and $8.90 in the second year. So again, we are going to calculate the new stock price based on our rate of return for the investor. However, surprisingly, it will also give you $17.36, which is again the same as the previous calculation. And the value of the company is again 17,360. So again, we are confirming whether whatever we choose as our dividend payout ratio, in this simple example, we are experiencing the same stock price regardless of the dividend payout ratio, and the same value of the company regardless of the dividend payout ratio. So this is the core of the irrelevance in the dividend payout ratio, dividend policy. And from the point of view of an investor, this applies the same. So suppose that we have an investor X, and this guy, she has 10 shares of Wharton Corporation. So this company that we have been discussing, and she prefers dividends $10 in the first year and the $10 again in the second year. And then suddenly Wharton was doing it. However, now suddenly they have changed their dividend policy. So they are moving their dividend policy from case 1 to case 3, where the dividend ratio is 110%. And then let's see what happens to the investor X. Actually, it does not affect the investor X happiness, because investor X can get $10 per share in both of the year. So in the first year, because she has 10 shares, and because the company has decided to pay $11 for each of the share, she will receive $110. So she is getting more than she has expected. And unfortunately, she didn't like this case, so she is going to consume only $100, and the rest of the money, which is $10, will be reinvested to the company. So she will buy more shares, which is worth of $10. And then in the second year, because of the shares that she had before, the 10 shares, she will get $89, because in the second year, in the case 3, the dividend per share is 8.9, and she has 10 shares, so 10 times 8.9 is 89. And additionally, she will get another dividend from the shares that she purchased in the first year, and she invested $10 additionally, and you will give her $10% rate of return, so it will give you 11. So 89 plus 11 is again $100, so she can have $100 in the second year. So the company's decision to change their dividend payout policy did not affect investor X's decision to get $100 for each of the year. And we can think about another investor, Z, and she is having 10 shares similarly. However, she prefers to have the dividends per share in the first year. So she wants to get more now. And right now, and for this case, let's assume that the Wharton, the company, would change its dividend policy from case 3 to case 1. So the company is changing the dividend payout ratio from $110 to 100%. And investor Z will get $100 in the first year because she has 10 shares, and the company will give the shareholder $10 per share as the dividend based on the case 1. And she wants additional $10, so what she can do is selling some of the shares, and the number of shares will be reduced, and she can get $10. So she can have $110 in the first year, and in the second year, now originally she was supposed to get $100 because she had $10 of the 10 shares of the company. However, now her shares have been reduced because she sold some of the shares, so she will lose some of the money in the second year. The amount of the money that she had lost is 10 times 1.1 because this is the rate of return, and she will get $89 in the second year. So therefore, she has obtained her ideal dividend policy, which is to get 110 in the first year, and later maybe she is satisfied with a reduced dividend in the second year. So again, in this case, the company's decision to reduce the dividend policy, to change the dividend payout ratio from 110% to 100%, it didn't affect an investor's decision to have more dividends in the first year. So again, we are looking at the irrelevance of the dividend payout policy. So no matter what the company chooses, investors can always create their own dividend payout ratio. Therefore, the company does not have to think about the dividend payout. Just the company can do whatever they like, and then it does not affect the value of the company. However, in reality, it does not work like this, and actually there are a lot of factors affecting the value of the firm through the dividend payout policy. So the first reason why the irrelevance does not work in reality is taxes. This is similar to the Modigliani and Miller theorem that we learned in the previous chapter. So when there are taxes, it will affect the behavior of the companies and the shareholders. So in reality, if you are a shareholder and if you get dividends, then the government will consider it as your income, your financial income, and therefore you are required to pay certain taxes for the dividend that you get. So your taxes will reduce the value of the dividend that you get, and so it will affect your wealth. And that means if the company pays dividends, then actually there is a reduction in the shareholders' value. Some of them will be transferred from shareholders to the government. So therefore, the value of the company will be reduced. In order to avoid that situation, the company should do their best not to pay taxes for the government. And one of the way is to reduce the dividends from the beginning. So it is more preferred to have a lower dividend payout ratio. So it will be especially emphasized, it will be more prevalent when the dividend income tax rate is high. On the contrary, if the tax rate on the dividend income is very low, then the company does not have to care about the money that will be transferred from the shareholders to the government, so they can just pay more dividends to their shareholders, and shareholders will be happy about that decision. And empirically, it was proven in the United States. So the next figure here, we have a graph showing the number of companies paying dividends, and on the x-axis we have time. So we from 2001 to 2006, and in 2003 the United States decided to reduce the taxes on the dividend income. And then suddenly, just after that decision, many companies started to pay dividends for their shareholders. And this one shows the effect that we have been discussing. So the taxes affect the dividend policy. So when the government extract the money from the shareholders as the taxes on the dividend, it will reduce the value of the shareholders, and therefore it will reduce the value of the company. So the company hesitate to pay dividends. However, now thanks to the new law, the company does not have to get that result, so they are nothing to worry about. So the number of companies paying dividends are increasing just after the change in the law. Another factor, the second factor affecting the dividend payout policy, is flotation cost, the cost of issuing securities. So in our example, when we discussed the irrelevance, we had a case 3. So, and in that case, we found that when the dividend payout is too high, the company needs to raise extra money outside, and therefore the companies need to pay to their outside investors at some point. And this means if the dividend payout ratio is too high, then the company needs to raise external financing, and external financing will be done through issuing securities. So for example, they can issue new shares or they can issue new bonds, and it will make them pay for the cost of issuing securities. And as we learned in the raising capital chapter, the cost of raising capital is significant. Thinking about the direct cost and the indirect cost, it will reduce the value of the company. So therefore, worrying about these flotation costs, the company will try to maintain a low dividend payout ratio, because if they need to increase the dividend, then if they are short of the money, then the company must prepare additional money outside, and they have to pay for the flotation cost. The third factor, so far we talked about the taxes and the flotation cost, and these two factors are lowering the dividend payout ratio. On the other hand, the third factor, this one will make a higher dividend ratio, which is the desire for the current income. There are a lot of different kinds of investors in this world. For example, you are young generations. However, we also have older generations who are at the age of their retirement. And after you retire, you are going to live based on the money you receive from your pension funds, and also your investment when you were young. So the retired people especially, they are very sensitive to the dividend income, because these are the money that they can spend their everyday life. So these investors will demand the companies to increase their dividend payout ratio, and at the same time they are going to seek some share of the companies that pay a higher dividend yield. Therefore, the companies, in order to meet their requirement, the company will prefer a high dividend payout ratio when there are many investors demanding higher dividends. So for example, in the United States, many retirees live on the dividend income, and that is one of the reasons explaining that why in the United States the companies are paying more dividends contrary to other countries around the world. And the fourth factor affecting the dividend payout policy is information content effect. And this one is similar to the pecking order theory in the previous chapter. So the pecking order theory explains that there is a signal of issuing common stock shares to the public investors. And when a company issue new shares, it will experience a dilution for their shareholders. And despite the fact that there exists a dilution, the shareholders are trying to issue new shares for outside investors, and therefore this is a bad signal that there is no way out for the company to recover from its current financial difficulties. And similarly, now we have information content effect. So suppose a company was paying higher dividends usually, and suddenly the company announced that this year we are contrary to our behavior in the previous days, now we are going to pay a smaller dividend this year. And people may think about the reason why the company is reducing the dividend, and one of the best solution, one of the best answers will be that the company has lost its profitability. So in the previous days, the company earned a lot of money, so that's why they paid a lot of dividends. However, right now, because of the financial problems and the economic difficulties, the company didn't earn what they expected, and that's why they are cutting dividends, because they don't have money. So that is a proper interpretation of the situation. Therefore, it will affect the shareholders' decisions. So some of the shareholders will try to sell their shares, and it will decrease the stock price in the stock market, and it will affect the value of the company. So the companies try to avoid the situation where they have to cut the dividends. So at the beginning, if they didn't pay dividend at all, then they don't have to worry about the situation. So if you are having a girlfriend, and if your girlfriend is making you trouble, then your decision is to break up with your girlfriend. So similarly, so the company does not want to have certain problems with the dividends. So from the beginning, they are not going to pay the dividends. So that's why they try to minimize the dividends from the first time. So according to this information content effect, companies often prefer a low dividend payout ratio. Okay, and the last one is about the clientele effect. So this one is about investors, the birds of the flock get together. So some investors prefer stocks with low dividend payout ratio. On the other hand, some others will prefer higher dividend payout ratios. So some investors will enjoy a higher dividend income right now. On the other hand, some others will invest to some companies that will grow in the future. And therefore, as a balance, the investors are investing to the companies that meet their requirements about the dividends. And then suddenly, if you shake up, so if a company changes its dividend payout ratio, then your previous investors will not be happy about that decision, because the reason that the investor was buying the shares of the company was that they find it very useful for the existing dividend payout ratio, and then suddenly your company has changed it, and they will be unhappy about that. So they will try to sell their shares, and they are going to find another company in the market that fits their need. So according to this clientele effect, you should not change your dividend quickly. So you have to maintain a certain level of the dividend, and if you go out of your track, then your investors will not be happy. They will be not satisfied, so they are going to leave the company. So it is more preferred to maintain the current level of the dividend payout ratio. Okay, so so far we talked about several factors that might create a difference between the ideal situation and the reality. So in an ideal setting, we know that the dividend policy is just a matter of timing. So whether or not you pay right now or later, it does not affect the shareholders' wealth. However, in reality, because of the taxes, the flotation cost, the people demanding current income, the information contained in your decision, and finally the clientele effect explains that if you change your dividend ratio, then it will affect your shareholders, and therefore the dividend payout ratio is very important. So certain factors affect make you to have a lower dividend payout ratio, while others let you have a higher dividend ratio. And in Thursday, we are going to talk about an alternative way to distribute your money to your shareholders. So the dividends are a regular payment. So usually you pay 4 times in a year, and on the contrary, stock repurchases can be done in some years, but soon later, if you do not have a stock repurchases, nobody will claim about it. So there is a significant difference between stock repurchases and the cash dividend. The cash dividends should be done regularly. On the other hand, stock repurchases, for the stock repurchases, you can choose to have or you can choose not to have. And that makes the stock repurchases more favorable option for the companies. So we are going to learn about that on Thursday.